Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Citi's Beata Manthey, navigating election scenarios, writing, a global equity strategy for Trump is premised on a stronger dollar, rising rates, trade policy uncertainty and a value rotation. A Harris strategy is premised on a weaker dollar, lower nominal yields, potential tax hikes and a general tilt towards climate-friendly policies. Beata joins us now for more. Beata, welcome to the programme. Given the polling over the weekend, how are you advocating for what clients should do? What are you telling them about how to navigate the next 48 hours and beyond in markets?
Good morning. Thanks for having me. So to us, within the equity market that I cover, the biggest, the most important call for the Trump win has been, of course, overweight the US versus the rest of the world. And just like all these macro trades that you've been talking about through the morning, stronger dollar or higher yields, this trade has also played out substantially. So at its peak, it's been 7% higher. There is a sense of the market taking off a bit of this profit, so it's up 6%. I would argue a lot of Trump win is still in the price. And that performance, of course, means that positioning is very stretched on the US versus Europe. In fact, it's one of the most stretched on relative basis positionings we've been having since the pandemic. So there is a very bearish setup of the investors going into the election day. And as Paul suggests, anything can happen.
Well, let's talk about Europe. I'd love a European perspective on this, how nervous European-based investors are about the potential Trump victory. And are they rethinking their domestic European allocations to equities because of it? How is their approach changing?
European investors and global investors have been very, very nervous about the allocation into the European equities, but that has already started around June with the political risks of French election, earnings for Europe coming off substantially, China worries, right? So we've entered this pre-election period with a lot of bearishness, a lot of underperformance, actually underlying EPS recessions for many cyclical sectors in Europe, which leaves us in a very interesting setup if Trump was not to win. Again, polls are 50-50, we really don't know, right? But the way I think about global equities, it's the US versus the rest of the world equities. And what is certain, and investors really don't argue with us about that, that within this rest of the world equity allocation, Europe looks most interesting right now because it's been so beaten up beforehand. So everything in equities is about changing balance of risks. And this balance of risks has been improving from very low levels, hasn't shown up in the performance right now, but should Harris win, that's definitely a very positive trigger for the rest of the world and Europe in particular. But on the other hand, if Trump wins, a lot of that trade has been already played out in Europe. Perhaps of Trump trades, continental Europe looks less attractive, but within the European equities, the UK, which tends to be more defensive and has a lot of energy weight in it, so FTSE 100 I'm talking about, this is the one that looks more interesting to go after if Trump was to win, and it hasn't played out yet.
There is a lot to unpack there, and I want to just go to what you expect in the immediate aftermath of us getting some sort of result from the election, because a lot of people are going to be up all night at their desks trying to figure out how much volatility there is and how they should play it. Are you saying that if it looks like Harris is winning, you could see a massive migration away from U.S. equities into European equities? Is that your base case?
The base case, yes, the rest of the world would outperform the U.S. equities should Harris win. And in terms of the volatility, of course, as the Trump trades have moved so fast, so quickly, investors have been anticipating higher volatility. That has been already playing out, especially last week. volatility is on track, historical trends in pre-election. So it is playing out, but I really think investors are in a sit and wait mode we are so close to the results that they'll take action once we have the results.
Yeah, well, Beata, there is this sort of fly in the ointment, and this is something a lot of people have pointed out, which is typically momentum tends to continue after an election, regardless of who wins. And then there's also the sense that if you look at fiscal stimulus, if you look at deficits, the trend is the same across the world, regardless of whether it's the U.S. or whether it's Europe, with the exception of Germany, which dances to its own music. I mean, how much are we talking about a world that is looking to stimulate cut rates and do the same thing, so it kind of leaves everybody in the same place?
Absolutely, and that is a very fair point that you are making. So election is an important event, but it is about everything else as well that will push equities higher or lower in the months to come. And one thing is certain, that yields will stay higher. Rates, despite the cuts that we have on the forecast, will still be high for longer. And if this trend of the economic surprises around the world continues, positive surprises continues, this would be an interesting setup for this improving balance of risks, where the rest of the world's equities versus the US should be better positioned.
Beata, wonderful to hear from you. Appreciate the perspective on the other side of the Atlantic. Beata Manthey there of Citi. Begin this hour with the equity rally stalling going into a defining week for financial markets worldwide, with some traders beginning to unwind Trump trades as the latest New York Times Siena poll shows Vice President Kamala Harris ahead in 5 of 7 key swing states, and one poll giving Harris the edge in Iowa, a state Trump won with ease in 2016 and in 2020. Mike Wilson of Morgan Stanley joins us now for more. Mike, it's good to see you.
Great, thanks for having me.
Let's get into this. The parallels between now and 2016, how strong are they?
They're not strong at all, because, I mean, like, at the end of the day, the business cycle and earnings and also interest rates will determine kind of where stocks trade over the next year or two. And in 2016, as you recall, we went into that election with a lot of slack in the economy, right? Things were slow. We had a manufacturing recession around the world in 15, 16. The Fed was, rates were pretty low. Generally, the economy, we had a lot of slack from a labor standpoint. So it could receive kind of a pro-reflationary policy strategy. Today, we don't have that slack. So prices are extremely high. Consumers and small businesses are much more, I would say, sensitive to higher interest rates. So rising interest rates and kind of a pro-cyclical strategy not going to be good for those types of stocks. And I think also the bond market now is in a much different position, right? We have way more debt, as you mentioned earlier. Then in 2016, we had plenty of slack in the borrowing markets. Today, we don't have that.
Here's what doesn't make sense to me then about the Trump trade. If you get bond yields that climb, how can risk assets keep rallying?
Well, I think it depends on why they're rallying. Okay, so I do think the equity markets are still nervous about growth concerns. I mean, the labor market's all over the place. I mean, people can make excuses for why it's better or worse month to month, but the general trend in labor is down. We're in a late cycle economy, so the equity market is worried about growth slowing, and that's why the Fed's cutting interest rates. Okay, so the bond market can't. I mean, the market goes up because growth is better, and people believe that, then it could be okay for equities. If bond market yields go up because term premium is widening, because of fiscal sustainability issues, then it's a problem.
Well, I guess the reason why I ask this is because the Trump trade the knee-jerk reaction supposedly is bond yields go up and equities rip, particularly in the more cyclical sectors. I'm thinking of financials. Based on the idea that you're not necessarily getting some sort of economic impulse that's immediately overlaid onto this scenario, why should risk assets continue to rally if yields continue to surge simply on this idea that the deficit's increasing and that bond vigilantes suddenly could be back?
Well, I mean, first of all, the financials is a little bit different because that's a dereg sort of call, and I do think that one's fairly visible. I think if you have a Trump presidency and maybe even a red sweep, you could get more lenient regulatory environment, maybe M&A picks up. That's kind of the financials trade, but that's unique. And we don't think the financials have really rallied that much on that trade yet. It's been more about the third quarter earnings season season, and the fact that we went into that earnings season with not a lot of high expectations. So I think there's scope for further follow-through in certain quote-unquote Trump trades. At the same time, there's probably, the other side, which is I think a lot of the negative trades have played out for the Trump trades. I mean, bonds have sold off probably too much, and the renewables and things like consumer goods companies that will be hurt by tariffs have really been hammered. So if Harris wins, you could see a pretty big rebound in some markets. So there's a lot of permutations here. It's not as clear-cut. I think you said it exactly right. It's all about the setup. Okay, stocks and asset prices move based on positioning as much as they do about the actual news. I'm looking for a clearing event. Okay, I'm hoping this is a clearing event, and then we can kind of get back to doing what we get paid to do, which is analyze interest rates, earnings growth, and kind of multiples, trying to figure out, okay, what's the fundamental case here? And my guess is that could take maybe a month to kind of clear.
When it comes to a clearing event, would you agree with Kit Jukes that it's either likely going to be a Republican sweep or Harris with gridlock, a.k.a. Republican Senate? Yeah,
I think that's probably, that's what the prediction markets say. I mean, who am I to argue with that? But it's not like it's a slam dunk, okay? I do not agree with the view that a Republican sweep is the best outcome for equities. I think it's probably Trump with a divided Congress.
But a Republican sweep means a 15% corporate tax rate, potentially.
Potentially. I mean, let's see if they can actually get that through. I mean, the bond vigilantes may come for them if they try to cut taxes in that sort of form or fashion. And they're not even talking about, they're talking about at the margin trying to reduce some taxes, maybe extending some certain things. I think the bond market.
The margins, the whole election has been a tax cut election.
Yeah, but I don't think that's priced. Just like in 2016. Remember, in 2016, nobody priced that bond cut until December of 17 when the Senate actually passed it. I mean, the whole year is like, this is never going to happen, it's never going to happen. I think the markets they always wait for the actual evidence to actually trade those types of events, particularly when it comes to Congress.
You said the most beneficial, Trump with divided government.
Yeah.
Can you explain that just a little bit more?
Well, the market's like uncertain. They don't want one party in power. I do think that a Trump, we said this all along, Trump presidency is probably more pro-growth, okay? Maybe not as good for bonds. Harris would be probably a little less growth, but probably better for bonds. And that's been our general view even prior to the last couple of weeks as things have kind of traded through. Now, at the margin, is it going to be dramatically better? I don't know. The markets have already priced a lot, right? You know what I'm saying? Like, that's the problem. We've already priced a lot of good news. And let's take a step back, too. We're trading almost 22 times earnings, okay? In 2016, we were trading 16.5 times earnings. So you got 5.5 multiple points of, we got to justify that no matter who wins this election. So we're just in a totally different setup going into this election.
So Ed Yardeni of Yardeni Research was on the program earlier this morning and essentially said to us, choppy road to nowhere, flat market into year end. Do you share that view?
Well, choppy meaning there could still be some big swings. I mean, maybe we end up flat from here to there, but there's going to be some big trading opportunities between here and there. I think we could see 6,000 potentially, in some sort of a clearing event that isn't, there's not a lot of consternation. People feel good about things. But then I think it's really hard for us to get past 6,000, 6,100 in any scenario, because then you're so stretched on valuation, and I don't see growth accelerating in a kind of way which would justify even higher multiples for 2025.
Can you explain what this clearing event for a month looks like?
No, I can't.
Okay, all right. Well, can you give us a sense of what that could mean? I mean, is it basically just whipsawing every single day, or is it basically that you see one trade in particular that you could see really getting blown up during that period of time?
Well, I could see many trades getting blown up, not just because of the election, but because, once again, we're very stressed. We're into the FOMO season, right? People need to perform the next 2 months. There's a lot of things going on here. And so I could see a blow-off move of some kind, post-election, a clearing event, but then reality sets in that we're going to have some kind of fiscal consolidation next year, no matter who wins. And in my view, I think that has to happen. And that, that's going to create uncertainty again. And then positioning gets kind of whipped around. The other thing that's going on is that Mag 7, which reported last week, was a mixed bag. What I was, we've been more pro-cyclical. What I was worried about last week was that they would come in with such great results that it would suck all the oxygen out of the markets again. So that didn't happen. But if we were to get a new theme, for example, let's say a new theme pops up, I can guarantee this, the money's going to flock to that theme very quickly, because that's what we need right now. We need something to get excited about, and we're kind of lacking in that. But something will happen, right? In other words, the market will find a new shiny toy, and it will move to that shiny toy.
Right now, the Fed is not the shiny toy. We have barely mentioned the Fed's meeting on Thursday. How much does that matter to this entire equation?
Isn't it Wednesday? You said it's Thursday?
It's Thursday. Decision
Thursday.
time.
Moved it back.
Yeah.
I know,
Okay.
it's very
the election.
unusual.
Yeah, but Wednesday, they're meeting on Wednesday.
Yeah, they're meeting on
Yeah,
Wednesday,
fine,
but we
fine.
have the decision on
They're still
Thursday.
meeting. They're going to know what happened, or think they're. Anyways, yes. What do I think? I mean, they don't have any crystal ball. I don't think the election is going to change their decision making. So right now it's 25 basis points.
Do they change yours?
No, at the end of the day, the Fed's is somewhat on autopilot, assuming the economy doesn't take a really bad turn, then they got to cut even more rapidly. I think that the trick for the equity market is going to be what's their tone, the dovish tone or hawkish tone. Is it a hawkish cut or is it a dovish cut? But that's 1 or 2%. That's not a 10% move on the Fed. The Fed is kind of over here now. They're doing their thing. They made their decision. That was September. That was a shiny toy in September.
Right.
But now we've kind of got off of that. And now it's about earnings. And then as we go into year end, it's going to be how does 2025 settle in for the economy, for earnings growth, and where should multiples be based on how the equity markets are interpreting the move in bond yields.
Looking forward to having that conversation with you, Mike. It's good to see you, sir. Thank you. Mike Wilson there of Morgan Stanley. Saira Malik of Nuveen joins us now for more to talk about the election and what it means for financial markets. Sarah, what are you doing going into tomorrow? And I know it's super short term and super tactical, but given where this market has been, how are you thinking about the price action beyond Tuesday into Wednesday and through next week?
It's good to see you, Jonathan. Well, the stakes are high this week for 3 reasons, and that's the Fed earnings and the election. So let's start with the 2 perhaps more certain ones for the market. For the Fed, we expect 25 basis points, even with that 12,000 payrolls that we saw on Friday. Earnings have been strong. There's optimism there. Estimates did come down going into earnings seasons, but we are growing at about 4 to 5% year over year, and about 3/4 of companies are beating earnings. Now, going to the election, I think we're going to see caution with the markets, more of a defensive trade. First of all, markets don't like uncertainty. And we keep talking about which candidate will win, but we also need to talk about when will the candidate win. I think there's a reasonably high chance that we have a contested election, and we don't have an answer to who our next president is for days and perhaps weeks. In the year 2000, it took 24 trading days to decide who our president was going to be, and the markets were down about 4 to 5% during that period.
What kind of market volatility could we see if that happens this time around?
I think, first of all, the markets have been starting to pre-price in Trump winning. So we're seeing today a bit of that unwinding because of that poll that came out of Iowa. So markets have started to price this in. This is unlike 2016, where markets were surprised by his win. So we're seeing that start to unwind a little bit. And then I think the issue of who will win is going to cause the markets to just go into more of a defensive mode. We're also in a different period. Today, S&P 500 valuations are at the 3rd highest level since the year 1999. So 1999, we had a S&P 500 valuation higher than today, and in 2021 we did. And we know how both of those periods ended. So this is not a cheap market that's going into quite a bit of uncertainty over the next few days and weeks.
You mentioned the Des Moines, Iowa poll. What do you make of that and its impact on financial markets? There's been no data, just this one poll coming out of a state that many view as solid red.
Well, markets keep trying to trade off of the polls, and as you've seen, they've been very tight. And there's a lot of uncertainty around polls, which markets have learned the hard way in recent presidential cycles. So I think it's just very challenging at this point. I think what we can assume is the race will be tight. There may be disagreement over who wins the race. There could be a delay in figuring that out. That's going to bring a period of days or weeks of uncertainty. But eventually, markets are going to move on from the election, and they're going to focus on 2 things for the next president: taxes and tariffs, and what do those mean for the economies. We heard a bit about that from the prior guest he was on. So markets will eventually move back to fundamentals. So that's why, I would say, even though we're cautious going into the next few days and weeks, over the long term, we will be focusing more on earnings growth and really what's going to drive this economy going forward, which will be employment, the consumer, and inflation issues.
That's the earnings side. That's the equity side. You say back to fundamentals, and it raises this question: the new normal, is it with bonds as a ballast, or is it with bonds as a risk asset? And that's a real question, because so far in this period of uncertainty, bonds have actually been the center of the volatility and expected volatility going forward. Is that the new normal we can expect after the election?
Well, we've seen rates back up in credit, and that's because people are looking at Fed rate cuts and assuming they're going to be less than what we'd hope for. The economy remains strong, and that's caused fixed income to struggle a little bit. But we think this is a period where areas of fixed income where fundamentals are strong, like municipal bonds, where state rainy day funds are very strong and their saving rates are high. This is where you can start to lock in yields. There is a lot of cash sitting on the sidelines, and we expect rates to go down for cash going forward. So your return's going to deteriorate. You can take incrementally a little bit more risk, and start legging into bonds and locking in some yields at this point in the areas that are strong, such as municipal bonds.
You said that stocks seem expensive at a point of such uncertainty. Don't bonds seem pretty expensive too? I'm talking on the credit side, on some of the riskier side.
Well, I think it's challenging. We're not looking to take more duration at this point because of what's going on with the economy and also our forecast for, we think that the 10-year got a little bit too optimistic on the downside. And now I think it's a little bit over 4% is a little bit too negative in that sense in terms of where it can go. We see that trading in a range. So we're not taking on more duration here. We're looking for those areas with strong fundamentals. I mentioned municipal bonds, also preferred securities with the backings of banks. So you need to be selective there, but there are areas where you can leg out of cash and leg in and lock in some strong yields at this point.
Sarah, always appreciate catching up with you. Just one final word on single names. You usually offer some stocks. What are the ones you like right now, given everything you've just said?
Well, I'll be watching closely today. We're not huge. I'm not hugely bullish on it, but looking at Marriott today just to get a glimpse into the consumer and spending on travel, watching for corporate travel and how much room growth they can grow next year. I think that they're going to report before the open, and they're going to give us a good view into what's going on with the consumer and travel.
Sarah, appreciate it. It's good to see you. As always, Saira Malik there of Nuveen. Thank you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.